Just dropping the rate. There are consequential changes. The RWT rules for interest for companies are also being decreased, and similar to what happened last time, there was a company tax decrease. There are transitional rules for imputation credits, so that companies have 2 years to basically pay out their higher value imputation credits. And there are also changes to provisional tax, so that companies can access the new lower company tax rate from the start of the next income year. In terms of savings, that was one of the other sort of messages the government was trying to get across in its package. In deciding to lower the company tax rate to 28%, it raised the question of, in particular, what do they do with pies? Previously, the top pie rate was 30%, the same as the company rate. The tax working group had come out and said, we think that actually should be aligned with the top personal rate. That's a bit of a savings incentive and we don't like it. It's a way of people sheltering their investment income. And if you put your money in a bank account as an individual, you would pay, as it was then, 38%. Why should you only pay 30% in a pie? It doesn't make for a very coherent system. The government had a look at the issue, decided that actually that they would go for the simple option and reduce the top pie rate to 28%. And the kind of reason that they did that is, if they decided to raise the pie rate to 33 to equal the top personal rate, what's the difference between an investment in a pie and an investment just in a company? Why should one get 28 and one get 33%? Now, we could have possibly brought some rules in to try and define what an investment company was, but that's going to be difficult to understand, difficult to implement. I think the government just said, let's just keep it simple and drop the top pie rate to 28%. You keep that as a bit of a savings incentive for people. So that's also happening from 1 October. And alongside all the other personal tax cuts, the lower pie rates are also going down from the same date. As I said, it had to be a fiscally neutral package, so there was all the good stuff in terms of tax cuts for individuals and tax cuts for companies, but the government needed to raise money in some way to fund this package. Part of that is happening through the GST increase, but a lot of that money generated through raising the GST rate to 15 is actually being refunded back to compensate lower income individuals and to increase benefits and make sure no one's worse off. So they actually needed to raise additional revenue. They ruled out a lot of the more controversial revenue raises like CGT and land tax. So it didn't really leave much for us to play with in terms of trying to balance the books. What they did end up doing is looking at the depreciation rules. The tax working group had a look at those as part of its work. It kind of had focused on 2 areas. One was in terms of buildings in the property sector. As we said, the government and the tax working group had a feeling, and they had data to support it, that the property sector wasn't really paying its fair share of tax. They felt they weren't collecting enough money from that sector. The Treasury had some analysis of quotable value data, which indicates that New Zealand buildings don't actually depreciate. And so, looking at that, the tax working group said, if we're going to have this broad-based system with no incentives and a low rate, broad base, we don't want to give incentives, and if something's not actually decreasing in value, why should you get a tax deduction for it? That's almost like an incentive if it's not actually declining in value. So what the government has done is reduce the depreciation rate to 0% for all buildings, so that residential, rentals, commercial and industrial buildings, the rate has basically dropped to 0% from the start of the next income year. It talks about buildings with an estimated useful life of 50 years in terms of the budget documentation. What that actually means is pretty much all buildings. All buildings will now have a rate of 0%. There is still a few categories which will be allowed tax depreciation deductions, and these are sort of specific categories like chemical works or tanneries, some agricultural buildings, where in their revenue estimates they actually have a life shorter than 50 years. They will continue to have tax depreciation. And there is the ability, if there's a category of building which isn't covered, and there's data and evidence to show that as a class that doesn't have a life of 50 years, can apply it in their revenue and have a rate allocated. And in that case, you'll be able to still claim tax depreciation deductions. The other area that the tax working group and then the government has picked up on is in relation to depreciation loading. So this is the 20% accelerated deduction that you could have for plant and equipment. It was brought in a few years ago as an incentive to encourage businesses to spend more in terms of plant and equipment. The tax working group had a look at it and said actually New Zealand's tax depreciation rates for plant and equipment are quite high on a sort of international comparison. This 20% is higher than the actual economic depreciation. It's an incentive. We're going for a broad-based, low-rate, simple system. We don't want tax incentives, and we don't think that we should continue to have loading. So that's been removed for any assets purchased after budget date. They continue to still have, plant and equipment will continue to still have tax depreciation, but it'll only be at the economic rate. You won't get that extra 20% accelerated deduction. For any assets, plant and equipment that you owned prior to budget day, you keep the same rate. You don't, it's grandparented, so you don't have to change that. So it's new assets that you purchase after that date. There were a couple of other little small changes. Inland Revenue changed its interpretation last year in terms of certain items that had been treated as plant. That came out and said actually we think these are buildings. At the time that statement was released in July last year, the Minister of Revenue said we're going to grandfather anyone affected by this change in interpretation, so that if you still had one of these, if you had one of these buildings before Inland Revenue changing its interpretation, you can carry on with the old treatment. There's only a small group, things like car parking buildings, powder drying, it's a small group, and it's kind of covered off in the fact sheets that were released by budget, but it's just to tidy up from last year. The other change was in relation to capital contributions. This is where, particularly for utility companies, a farmer asked me to ask the utility company to connect their new building to the electricity network. It's not economic for them to do so, so they require a capital payment from that farmer to actually go ahead. Under sort of prior law, that payment wasn't taxable to the utility company, but they could claim a full depreciation deduction, even for the sum funded by the customer. So there's just been a change to say the business either chooses to treat that as taxable and spread it over 10 years, or they reduce their depreciation base just to take out their contribution. In terms of just some of the other measures included in the package, the thin capitalisation rules, these are basically rules that apply to New Zealand companies controlled by foreigners. What could happen without them is, as a foreign-owned company, you push all your debt into New Zealand and basically put that against your New Zealand tax liability, reduce the amount of tax you pay here. So we have some rules that say there's a cap on the amount of debt funding those businesses are allowed. The tax working group had a look and said actually that 75% cap that we had wasn't really consistent with commercial funding ratios, and recommended reducing that to 60 just to tighten up the rules for those businesses. So that's come through in the budget. There were some changes to deal with what are called Phoenix schemes. These are sort of related party land transactions where a person buying some land would, for GST purposes, get a refund for that purchase. The vendor that they were related to would go out of business before they had to return the GST. So there's some changes now to say that's actually zero rated, so you can't claim that refund up front. There were a couple of small changes to working for families. You've probably heard in the media in terms of people using their property or investment losses to reduce their other income and claim more working for families. There's been a change to basically say that you're unable to do that from 1 April. While the working for families payments in general are increased from 1 October to counter the GST increase, the threshold at which you start to abate or lose your working for families, that's no longer going to be indexed. And finally, in the budget, the government announced some additional funding for inland revenue, 120 million over 4 years, basically looking at debt management, further audit work in terms of property and in terms of the hidden economy.